For the second day in a row, the Nifty stared at 26,000 mark and blinked. We have hit our intraday high of 26,009 before the altitude sickness set in, dragging the index down to close absolutely flat. While the headline numbers looked calm, there was a chaos beneath the surface. Eicher Motors exploded 6.5% on a blowout earnings, while TCS and Infosys were hammered, dragging the IT index down to nearly 2%. We have formed another Doji candle of indecision right at the lifetime high resistance. The market is coiling like a spring. Big question for Thursday is, which way will it snap? Let's decode the setup. Good morning everyone, my name is Ajay and welcome to the smart edition of Nifty 50 Market Analysis. We are heading into Thursday, February 12th, 2026, which is the weekly expiry for the Sensex options. Yesterday was a day of sharp sectoral divergence. Let's recap the market for February 11th. Nifty 50 opened higher, tested a 26,000 wall at 26,009 and settled at 25,954, just 19 points or 0.07 higher. Sensex slipped 40 points to close at 84,234. Bank Nifty outperformed slightly, rising 0.2% to close at 60,745. The driver was the positive global cues at the US-India trade deal narrative kept the floor intact, but the profit booking at higher levels capped the upside. Let's come to the segment 1, Sector Watch, the Eicher surprise versus IT drag. It was a tale of two sectors, the hero Auto and Eicher Motors. Eicher Motors, Royal Enfield, the top Nifty gainer surging 6.5% to a record high of 7,805. And the reason was the net profit of Eicher Motors jumped 21% YOY to 1,421 crores, beating estimates. This powered the entire auto index up by 1.3%. The villain for today was IT sector. Nifty IT index crashed almost 1.76%. The reason was the weak US economic data raised fear of clients' spending cuts. TCS fell almost 2.5% and Infosys dropped by 1.8%, dragging the entire market down. Now let's come to the segment 2, Technical Outlook Expiry Special. Today is Sensex weekly expiry. The charts are screaming indecisions at the top. The pattern is back-to-back dojis. Nifty has formed two consecutive doji candles, Tuesday and Wednesday, right at 26,000 resistance. This signifies a massive tug-of-war between arbitrageurs and hedgers. A breakup from this two-day range, 25,900 and 26,009, will unleash a big move. Zone 1, resistance. The ceiling, level 26,000 to 26,050. The expiry strategy. Call writing is heaviest at 26,000 strike. If the Nifty opens flat and shows rejection near 25,990 again, option sellers will likely defend this level aggressively. Watch for the double top pattern to initiate short-term hedging positions. The zone 2, support zone. The floor. Levels are 25,800 to 25,850. This is the immediate support. Put writers are active here. As long as we hold 25,800, the underlying trend remains positive. A breakdown below 25,800 could trigger long unwinding towards the 50-day SMA at 25,750. So let's come to the segment 3, institution flows. Foreign institutional investors remain net buyers in the cash market, purchasing 13,432 crores gross with a net buying of modest 30 crores on Feb 11. They are not selling, which is the key. The DI flows, domestic institutional investors were the net buyers of 250 crores, absorbing the selling in the IT stocks. So with these updates, we come to the end of our session. To conclude, I must remind you that today is Sensex expiry. Expect volatilities to spike after 1:30 p.m. as hedgers adjust their positions. The battle is clearly defined. The bulls want to close above 26,000 and the bears want to push below 25,800. Do not participate. Let the price confirm the direction. My name is Ajayika and I'll see you tomorrow with the major updates that can make or break the markets. Take care of your mental and physical health. Bye-bye.